Excuse me. All right. So this week we are getting into the third section of the class, which is the valuation. And so what you should have done as part of the video is turned in an as-is valuation of Nike, right? So I posted, share my desktop. I posted to Elms a folder under week 4 called Nike, which would have the as-is valuation model solution that you should have matched and turned in. So that would be basically this file. All right. So the key here for the as-is valuation, and we're about to update it to April 1st, 2020, is that generally cash flows, forecasted cash flows, should lead to a price. And that's kind of what the model does. If I know the cash flows of the model, I know the financial statements and the ratios, that the ratios create the income statements and balance sheets, which create the cash flows, the CFI, which creates the valuation. Okay? So cash flows lead to price. So the point of the as-is valuation is if we know the price, we should be able to work backwards to get the cash flows. And essentially, that's what you did, again, with the assumptions, in the Nike model. Okay? And so at the time of the video, the share price was about $95, $94.56, and the idea is we wanted to be close to $1. So what this gave us is a sense of kind of like what Wall Street was thinking about Nike. So in this case, if I think about what Wall Street was thinking, well, what do we have here? Well, what we have here is a valuation at the time that said, here's what they thought the growth rate was going to be. Here's the margin. Here was the approximate tax rate. And given that information, this would be the share price. Okay. So that's what you turned in. That's what you submitted. Right. So what I want to do, and this is going to kind of cover two pieces, kind of set us up for next week, as well as set you up for your group projects, is talk about how we would update this model for today. Okay, so essentially, I'm going to save this file, and we're just going to call this April 2020 as is. Okay, so I can start making changes. So what we would do if we were to take the model that you built and update it for today, and this is the piece that I'll help you with in Bloomberg, is first of all, we would want to kind of look up Nike, and we want to make sure that a few of the assumptions were the same. So one of the assumptions we made was, what is Nike's WACC? And at the time of the valuation, their WACC was 7.7%. Well, that could change today. So the WACC as of April 2020, back to Bloomberg, Nike, I don't know why, US equity. And if we look up their current WACC, it is 10.1%. Okay, so I'm going to take a screenshot of this, and I'll call this NKE-WACC. So that is their WACC. So if we were updating Nike today, we would use their WACC today, which would be 10.1%, right? And then what we'd have to do is we'd have to check some of these other numbers, but the next thing we'd want to look at is the share count to see if it has changed. And that is going to be on a separate Bloomberg screen called DES for description. And this is very important because you're going to see screenshots like this that you're going to use for your next assignment and group project. Down here is the current share count. Bloomberg just kind of tracks it for investors. So it's 1242.4. So 1242.4. Okay. And as of right now, today, so let me go ahead and take a screenshot here so you can see this. Nike DES. As of today, their share price closed at 79.23. So 79.23, right? And then the third thing that we would have to update to get to today is whether or not the revenue and EBITDA estimates have changed for Nike. So we would go to a third screen, and these are called EEO, and this is the consensus estimates from Wall Street today on what Nike's expected to do over the next several years. Okay, so if I look at the consensus estimates, and again, I'm going to save this screenshot so we have a copy of it, NKE-EEO. And we can see that, for example, in 2020, Nike's revenue 39,276, 2021 42,543 billion, 47,097. Okay, so compared to where we were with the video, what's happened in the last few months, these revenue forecasts for these next 3 years have come down. Probably one of the reasons share price lower. So instead of 42,194 for 2020, today for 2020, it's 39,276. So 39,276. For 2021, instead of 45,641, today Wall Street's expecting 42,534. And for 2022, Wall Street's expecting, why that's doing this. Stop. I don't know how I got to Farmville. Okay, kill Farmville. For 2022, it's now revenue 47,097. 47,097. So basically, Wall Street's been projecting down revenue, obviously because of the coronavirus. Now for EBITDA estimates, again, we'd want to put those in for the next 3 years. So again, as of today, 5073. 5875. And 7011. And finally, the forward multiples are probably different today. So today, second forward year, 1, 2, they traded at an EV to sales, EV to revenue of 2.98 times revenue. And their EV to EBIT is 21.99 times second year forward EBIT, 21.99, which suggests a 13.6 operating margin into perpetuity. So how does this play out? Well, this is going to play out if we go to the next screen, which is the ratios, where the growth rates have automatically been updated, and the EBITDA margins have automatically been updated, and so has the share price, by the way. So now we have to look and say, okay, is this tax rate for Nike still reasonable? Okay, and right now we used 16% a few months ago. So one of the things that I would have done is I would have gone to Nike and I would have looked at the fourth quarter or their last quarterly earnings call transcript. And that would be right here. Okay? So one of the things Bloomberg does is they actually do transcripts of earnings calls. So we would have opened the earnings call transcript, which is a PDF file, which I would save for you. And we would search for tax rate to see if there was a sense of what the tax rate is going to be. And they said, well, our effective tax rate the quarter was only 4% versus 14.7, yada, yada, blah, blah, blah. Let's see if there's other mentions of tax rate. Next, that was the only mention of tax rate. So they didn't really talk too much, except they said there was a one-off there. So here's the next thing we would do is we would go to an analyst report, because the analysts are also trying to figure out the tax rate. And we'd say, okay, JP Morgan usually puts it in here. So here's a JP Morgan analyst report for Nike. Because again, they're doing the same thing we're doing. I'll save this as well. But basically, in the JP Morgan report, right here, they are forecasting tax rate of 16% to be 10.1 and then 15. Okay, so when we were doing this model, 15.0, we had a tax rate of 16 going down to 13. And what JP Morgan is actually saying is it's probably likely to be for 20, 10.1 followed by 15. So 10.1, can't do this right, 10.1 followed by 15. And for this year, they thought it was going to be, what was it? 16.1. It's pretty close to the number we had, which was 16. So let me put this at 16.1. Okay. Again, just so you can see what I'm doing, add an extra decimal place. So we've updated the tax rate through today. Right? Now, the next thing we need to do is we need to make sure, again, we got the EBITDA margin and we need the revenue growth rate, but we have the EBITDA margin for the next 3 years based on what the analysts are doing. But we need to know what the perpetuity number is. So we're going to talk about this in 2 weeks when we get to multiples, but this is the formula to estimate perpetuity EBIT / operating margin. Said another way, 13.6% is this row, this number. So based on the trading multiples today, that number should be 13.6%, just kind of working backwards on the math, right? So essentially we can't change that number, but we're pretty close to the perpetuity number. So here's the point. How do I get this 13.6? 15.4. So that pretty much is what the market is saying, because remember, this is our perpetuity year, is the margins for Nike long-term. So you have a pretty good sense of the margins, right? For the first 3 years in perpetuity, got a pretty good sense for the tax rate. We're going to have to figure out revenue, but I got one more challenge, which is what about the balance sheet? So that's where invested capital to sales comes in, okay? These numbers in the tree analysis are these numbers. We walk through the tree, okay? And this is invested capital per dollar of sales. So historically, the productivity, invested capital to sales, been 27 cents, low as 25, high at 29. Last year, they were at 25 cents of investment per dollar of sales. Given these income statement, or sorry, balance sheet ratios, which are all percentage of the balance of the income statement tied to revenue, then we're actually forecasting that productivity would maintain at 25%. So given that this is probably the lower end of the range, but the point is somewhere around here seems like a reasonable forecast. I probably don't need to tweak the balance sheet ratios, that they're at 25 cents per dollar of investment based on these income statement ratios, sorry, balance sheet ratios. So kind of okay on productivity, and this is going to help us forecast gross investment. So what it leads to is the last thing that's going to help us match up these two share prices to get the current share price and the model share price within $1 is probably going to have to be growth rate, right? So if Nike is growing in the out years again at about 11%, it's still not enough to get us to the $79 share price, which is the current share price. So what's the difference? Well, the final number is going to be, under assumptions, the G. And right now we're using a G of 3%, which was essentially a placeholder for Nike, right? So basically what the market's saying is, and you think about this, they're growing about 10% a year in the out years, The growth of the perpetuity is not going to probably mature yet to 3%. So it's probably going to be a little bit higher than that. So let's try 4. And by the way, at a 4% G, we're at 66, 67. So go to 6. 6% G, we're at 89. So it's probably more like 5. Now I'm starting to get really close. So call it, I don't know, 5 to 3. Now I'm within 50 cents of their share price. So again, as is valuation, I will save what we just did. But basically, that's going to be kind of the process that we want to start to think through. And the whole idea is, I may not agree with Nike share price, but working backwards, these have to be the cash flows to generate that share price, and understanding sort of the math behind the DCF. Well, if this is about the taxes and this is about the margins, then this has to be the growth at this level of productivity. And essentially, we can back into a G, but we have a general sense of what the market must be using in their models that we could have backed into to get the current share price. That's the process for as is. So I've been on a monologue. I'm going to stop, pause, see if there's any questions or comments about what we just did or thoughts.
Could you just, when you talked about the balance sheet ratios again, could you just briefly describe your rationale there? I mean, were you just looking at it and saying, when you looked at the ROIC tree, there wasn't that big of a change, so you didn't really see a need to mess with that? Was that kind of what your thought process was? Or?
Well, sir, that's the point. So we did not really do an extended EIC analysis on Nike, right? But if we did, one of the things that you would have done in your I and your C is you would have talked about the industry growth rate in the future, and you probably would have thought about Nike's ability to maintain their advantage in the future, right? Which is a proxy for levels of investment, right? So the idea here is that this is historical productivity. Now, I'm not saying the past, guarantees the future, but if Nike's business isn't fundamentally changing, right, then, and again, these ratios are just referring to those historical numbers, then they're spending mid to high 20s as a percentage of sales on capital, right? So I need to basically come up with balance sheet ratios that say, all right, to have this level of productivity, this is what they're spending. And remember, the key in the model is that the entire balance sheet, because this is a percentage of revenue, is tied to sales. So as revenue grows, percentage of sales stays the same. The model is creating gross investment, right? So you didn't forecast gross investment, but we're backing into gross investment, the reinvestment rate, by basically saying, okay, if I know what the sales are and I know the percentage of sales, the difference in the invested capital base and the percentage of sales solves for gross investment, right? So that is what we're doing here. And we're saying, okay, about 25 cents per dollar is what's being spent. Now, if I wanted to say, no, I thought Nike's in the middle of the range, 27 cents per dollar, I could have taken, for example, net fixed assets of 12%, put them at 14%, right? And oh, by the way, it doesn't really change the share price all that much, okay? So even if I'm in the mid-range of productivity, or a couple percentage points, right, it's not gonna really affect things all that much, right? That was the other thing. So the balance sheet doesn't matter nearly as much as the income statement, right? But regardless, I could play around with the balance sheet if I were needed to. Does that make sense? Questions about that?
Yeah, thank you.
Sure. Other questions?
Hey, Professor, is there any case where we wouldn't use the WACC that was in Bloomberg if, say, for instance, because it increased a significant amount, I think, from the last time, if it's because of like the current situations or?
So let me give you another example. If I were to do Ford today, and I were to go to Bloomberg, share price is 440 at Ford, and I were to look at Ford's WACC, It's 2.6%. So I don't know if that's just an indictment of Ford or just how effed up the world is today. But the point is, who wants to basically put money into Ford long term and make 2.6%? They're a much more risky company than 2.6%. I mean, they're basically on the verge of being a junk bond. And you're telling me that I'd make 11% at Nike. Am I going to make 2% at Ford? Something seems a little off, right? So the problem is it's just math. When Bloomberg does it, it's just math. And every now and then, it's kind of like the exception proves the rule, is 80% of the time, 90% of the time, the Bloomberg whack is probably a reasonable whack. But every now and then, you're going to get some crazy whacks, and the analysts would never use 2.6% to value Ford long term. And part of the reason why it's 2.6% is they're 81% debt, and right now we're at an all-time low cost of debt. But the ironic part is, just because they borrowed this at this rate doesn't mean that people are going to lend to them in the future at that rate, because it's crushed their balance sheet right now and nobody's buying cars. So there's a lot more risk to that debt, right? So this underrepresents probably the true cost of capital. So if I'm an analyst, even though I said use the WACC, 2.6 seems a little low. I would probably use something different. In that situation, a way to validate it, if you have access to the data, is to look at the industry WACC, which you do. And so what I would have done is I would have gone back to the industry WACC, custom spread, and I would have said, okay, if I look at my spreads and I look at my WACCs, there's probably not too much difference in these automobile companies. So if the industry WACC is 8% and Ford's at 2%, realistically, they're probably closer to 8%, right? Now, I could say, okay, well, what if I just did, European automakers as a proxy, or US automakers, start playing around with this? That's something you can't do. But even so, even if I just said, hey, they're just like Europe, it's 5%, there's not too many in the US, unfortunately, anymore. But the point is, even if I use this list, the industry WACC is closer to 8%. So what I want to say is, there's an argument to say that 2.5, if I'm investing long-term, is too low, and then I would override it, okay? But for Nike, if I looked at their competitors, and I just looked at, hey, what's their industry WACC? Does it seem kind of out of line? Well, not necessarily, because they're all around 11% right now. Because if you think about the riskiness of every one of these clothing companies, nobody's buying clothes. Like, you can't go, at least I live in Maryland, where there's no stores to go buy these clothes, even if you want to. All right. So that's the problem, is that the risk of these companies is now much higher. And I think it's actually reflective of the industry peers. So people would probably use a number closer to this number in their models, as opposed to Ford. They would probably not use the one in Bloomberg, and they'd probably crank it up a little bit higher. Just to be clear, there's an art to the valuation. There is a qualitative side. There's a quantitative side. Formulas, everybody uses very similar formulas. Math is math. It's the assumption you put in. That's where it gets a little bit of differentiation. That's why analysts have different target share prices, because they might choose to use a different number. But for purposes of this class, as you do your models, at least once you have a justification for why you're putting these numbers in. Good questions. Other questions? All right, so back to Nike, updated through today, and I'm going to save this. And what I'm going to do is close out of this, and I'm going to go to our folder, which is in week 4 Nike, and I'm going to upload these files very quickly. Okay, so if you want to be playing along at home, this, if you didn't type it in, is what I just did. And these, file, new, downloads, these would be the files that we just downloaded for Nike, the EEO, with the earnings estimates, the DES for the share count and the share price, and the WACC. And I'm going to put those 3 files here as well, because this is going to be to some degree the roadmap of when you have to do your next as is at another company, how you're going to do it. Okay. Questions about, and again, anything so far? All right, so preview of what you're going to see next week on the videos is this is one model, which is the as is, but there's going to be 3 more Excel files that you are going to create, right? One is going to be called the bull, the other is going to be called the bear, and the third is going to be called the target, right? And so I think if I go back to that JP Morgan report, if I can find it, back to Bloomberg, where's Bloomberg? If I go back for Nike to the analyst reports, I think JP Morgan does it. So I'm going to go open this JP Morgan report. I'm going to scroll down. Blah, blah. Oh, here it is. So one of the things they're going to do is they're going to come up with a valuation, which is a target share price, right? But the other thing that the Wall Street people are going to do is they want you to know that there's some risk and uncertainty in what happens to the company. So for example, one of the things that could change is if average selling prices are different and volumes are different than anticipated, right? Or if there's tariffs which change, right, etc. So back to this, they don't draw the graph here, but the point is what some of the bankers will do is they'll basically show a graph. JP Morgan didn't on this version of the report, but they'll show a graph of the price, and when they forecast it, they'll say, here is the high range of the price, the bull, here is a graph of the low range of the price, here's the bear, and here's where we think our price is going to be for the company, and that's called the target. Okay, so that's now the next 3 models that we would need to create for Nike: the bull, the bear, and essentially the target, right? And the idea is the target is where you get to put in your opinion, right? So when you do the as is, we're not really putting in our opinion. We're kind of solving a multiple, equation problem, but basically we're putting in, using the math, reasonable assumptions that explain the current share price. Then, for whether we agree with the share price or not, the target is our ability to come up with our own share price. But before you go to the target, I want you to think about the range, right? And that's what's called the bull and the bear. So how high could this be in the next 12 months? How low could this go in the next 12 months? And more importantly, what could cause it to go higher or lower? Okay. So just very quickly, and I'll riff on this now for Nike. So we would create another file, save as, and we'll call this the as is, we'll call this the bull. And what's going to be very important in your next week's homework assignment is you're going to have to do a paper. And when the paper is written, I'm going to say, write up your assumptions. I'm going to be very specific about what I mean by that right here. So here's the idea. In a bull scenario, what could actually change for the better for Nike? How good could it get? Well, one of the things, if we go back to the JP Morgan report, is in selling prices, if selling prices are stronger and EBITDA margins, which are at 14.9%, went up 1%, closer to where they were historically coming out of this great recessionary time period. They don't just recover to 2019 levels, they recover to 2017 levels. Then a 15.9% EBITDA margin. I think the growth rate's already probably near the higher end of the range, but let's say they grow even a little faster at 12% and a little bit better long term. Instead of 5.3%, they grow at 6% a year. And then here's the point. I got to give a rationale. All right, I can't just throw numbers in. It's not just plugging and chugging. I'd have to explain why. So I'd have to say something like, okay, Nike leveraging their competitive advantage is going to grow faster because when the market recovers, I actually think that the weak players are going to get thrown out of the market, and those strong players are going to be even stronger because they're going to be the only game left in town. And so Nike's going to be in a great position to get better margins because there's going to be even less competition than there was before coming out of this virus-based depression that we're going to be in. And so since the strong survive, I think Nike, as the market recovers, will recover faster. They'll get more growth as people then buy more clothing, more shoes, more athleisure, and with less competition, I think they will get higher prices. I put that in, and oh, by the way, what share price is that? That's 93. More than 10% of the current share price, that would have been a buy. But here's the point. That's my bull scenario. Okay, that's my top. That says if everything goes well in the next 12 months, I think that's how high Nike could be. Save. Quit. File. Open. As is. Bear. Now, I put on my other hat and I put on shady, everything looks dark and gloomy. How bad can it get? How much worse can it get for Nike? Well, one of the things for Nike is, you know what? Growth never returns. This is a company that's going to now grow 5% a year, not 10% a year. And margins are going to actually get tougher in the future because the world really will be different. And they're not going to buy clothing in the same way. And I think it's going to be in a tougher business that's going to get them down to 14.5% margins. And oh, by the way, longer term, they're not going to grow nearly as fast. So they're going to grow 4% a year longer term. It's going to be a much more difficult road coming out of this great recession. Athleisure is really going to suffer. People are never going to buy clothes, that type of clothes at the same rate. I think there's going to be more competition and people are going to be less worried about brands, especially after a couple of years of not being able to pay for the brands. Nike's brand's going to suffer. They may not even get those contracts. And as a result of that, I made those changes. Oh, by the way, that would become a share price, $59 a share. So I have my bull, I have my bear, and I have my explanation of my range. Everybody see what I just did? I'm kind of going pretty fast because obviously you would have done some research to figure out what these scenarios are and did your opinion rather than just making stuff up like I did. But that's the idea generally of the bull and the bear. All right, so for people on the phone, now's the target. What do you think? Do you think we're going to be closer to the scenario as is written? Do you think you're going to be closer to the bear scenario that I just described? Or do you think we're going to be closer to the bull scenario? What do you actually think is going to happen to Nike? Who has an opinion?
I'll go ahead. I think that the next couple of years are probably going to be a bull market for Nike. I think everything you described about less competition is really going to come to a realization. I feel like the current state of affairs is going to make the small players in the market less competitive, and they're going to struggle through this challenge. So I think all factors aside, I'm still optimistic that this pandemic's not going to last too terribly long. We'll kind of get back to similar conditions to the state of affairs prior to the pandemic, and I think Nike will see more growth in a less competitive market.
So more than what the market represents today. So you're closer to my bull scenario than the current as is scenario. Okay.
Correct.
So Michael's opinion, and to be honest with you, we're all talking about the future, and none of us can actually say for certainty that that's actually a right or wrong opinion. But that's what I want you to do. I would want you to basically put that into writing and put this why you then changed the numbers that you did closer to the ones I did, and that's your goal. And that's what I want you to write up. Now, is anybody more pessimistic about Nike? Is anybody closer to the bear scenario? Does everybody else? Let me just say, let's see, based on the videos I can see, you know, where are you guys? Do you think the current share price is reasonable? They're priced effectively, therefore they're a hold. Do you think Nike's more of a bull, you should buy? Do you think Nike's more of a bear and you should sell? Where are you guys? What's your opinion on Nike? We had one person. Michael gave
My,
his.
my thinking is in line with what Michael said before. I mean, I think also one of the things long term is once this ends, I think they'll have even more purchasing power over their suppliers because manufacturers are going to be hurting a lot. So I think they'll be able to leverage and lower their costs even further. And as the lead producer in this space, I think they'll come out ahead.
By the way, what both of you just said is going to be very important for a good grade in your final projects, because what you say in the EIC should be syncing up with what you're putting into your valuation assumptions. So if this is your target share price and you said that this is what I actually thought Nike should be, then I would have expected the comments that he just made about supplier power to be written up in the EIC section consistently, right? Because what I'd hate to see, and this is where grades tend to get in trouble, but it does provide a source of comedy for me, is that the people who do the EIC don't talk to the people who are actually doing the valuation, kind of division of labor, and they say contradictory things. Okay, so that's the type of stuff that really hurts your grade. Because here's the whole point: what he just said about supplier power should be reflective of what you just put into this analysis. You shouldn't say the opposite. You shouldn't say, oh yeah, suppliers are going to have, you know, all the power, and it's going to be horrible for Nike. And then the person doing the valuation is like, oh, margins are skyrocketing. As I said, I get to chuckle with that one. So hopefully you won't do that. Does anybody have a pessimistic view on Nike? Want to give at least pessimistic more scenario? Go ahead.
I'll give the pessimistic scenario a try. I think that Nike was already struggling with manufacturing overseas. I think they've got a lot of plants in China and whatnot. And I think maybe after this whole pandemic is over, they put further restrictions and maybe even higher taxes, tariffs, and whatnot on some of those imports. And maybe they start to struggle.
So do you think that I represented kind of that bad scenario enough, or do you think it's even worse than some of my assumptions for the bad scenario?
I'm thinking it might be a little bit worse. I'm thinking it might definitely be worse.
So what would you, when you say worse, what might you have changed to make it worse? Even worse than I changed. Would you change the margin lower? Would you change the growth rate lower? What would you change?
Could you change the margin and maybe the tax rate?
So what would you change the margin to? I got it at 14.5. Actually 14.5, and then it goes back up to 15.4. Probably should have left it at 14.5. Boom, 55. So what margin would you say? $14?
Yeah, can we take it down to 14, maybe even 13?
Well, let's take it.
Let's
take it to 14, and then we'll work our way down to 15, 15 and a half, and then 13. By the way, if you do that, you're talking about a share price that's about 30, 40% below where they are trading today. I mean, that's a really tough scenario for the bear. And again, I'm not saying it's going to happen, But at least if you did a bear write-up, you could explain what the bear is, what the rationale is. But the other key as you're doing this is you got to talk about what does that actually change in terms of the assumptions. Because you can't just have a narrative without the numbers. So you got to say these narratives lead to these even lower growth rates, 14, 13 and a half, 13, right? And these even lower revenue growth rates, which gives me that $49 price. So I want the rationale of the numbers together when you do your write-up and when you talk about this, right? And some of it's going to feel like shooting from the hip. So that's the point. Ideally, you kind of do a combination of both quantitative analysis, look at a little bit of the history, but more importantly, the qualitative analysis. That's why we do EIC. That's why you can read news stories. And to some degree, it's you can kind of see almost what some of the analysts are saying, because one of the things is in the real world, they're talking about Nike a lot. And what are they really saying about Nike? Do you like them? So that's another thing that we can look at when we do our projects. Right? And then you come up with your opinion, which is the target. And the point I'd like to make about the target is today, if I actually look at these analysts, the Wall Street sell-side analysts, they're covering Nike. First comment I'd like to make is 28 of them are buys. So most of them are pretty popular. Can't talk today. Most of them are positive, thank you, on Nike's future. 6 of them are holds and 2 are negative. So the overall sentiment for Nike is actually fairly positive. But notice when you got the target share prices, they're all over the map. Like this guy Omar thinks they're worth 125 versus, let's see, different analysts, who the sells. Go over here. Scroll down. Who's some of the sells? Here's an analyst who thinks they're worth 64. And the other sells 72. Okay. So again, can't say the people that say 64 are wrong. Can't say the people that say 125 are wrong. But you kind of get a sense that, there's different opinions. And different opinions are what we just talked about in the call. Different people have different points of view. And then your job as somebody that's an investor is to try and figure out who do you believe. But here's the point. If you don't give me the range, you're not doing your job. Because even if you give me a recommendation, helping me understand what my up and downsides are, and more importantly, what could cause the ups and downsides, gives me much more comfort when I go into a stock. Because I need to know what are the things that could cause the stock to go through the floor. And that's what the whole point of the bear is. What are the things that could cause the stock to go through the roof? That's the point of the bear, so I can track things. And then it's just a question of, do I believe what you say about where they're going to be in that range? So by the way, your target should always be between the bull and the bear. The target's the last thing you do, because that's your opinion, where you feel you're on that continuum. Okay? And if you think they're fairly priced, easy target is a hold. But regardless, you got to explain why. And then the ratios that you're talking about in your paper, there's 5. You should always be talking about 5. Growth rate, EBITDA margin, tax rate, productivity, usually 6, WAC and G. Right? Probably not going to change productivity too much, so I said 5. So it's WAC, G, growth, margin, taxes. Those are the 5 drivers. No different than when you went through these ROIC drivers. That's what's going to drive value. All right, questions? So let's practice on Walmart. Because the other thing you're going to have to do is you're going to have to reuse this model to do another company. So how do we do this? So if I go back to, and you can either use your model or you could use the Nike model. All right, I'm going to use the Nike model that we just did. The Nike as is valuation that I uploaded here. Okay. There's a folder in week 4 called WMT. Stands for Walmart. It's got 4 files: the data, the DES, the EEO, and the WAC. So I want to talk about how do we take Walmart's data and put it into our Nike model so that we actually do an as-is valuation of Walmart. All right. So I'm going to pull up a spreadsheet. And now the first tab, when I do another company that I have to update, is model data. So this has the raw data for Nike that came from Bloomberg. So file, save as. This is now my Walmart as is valuation April 2020. As opposed to my Nike valuation. So I'll put this in the Walmart folder. Wrong Walmart folder. 78p, spring, Walmart. Oh, here it is. All right, save. All right, so here's what I want to do. I want to take the first file that matters in my Walmart folder. Too many files up in here. Is the file called data. Okay, so I will give you this file for each of your companies, whether it's the assignment or whether it's your group projects. And what you're going to do is you're going to select the whole tab of the data. You're going to copy it. You're going to come to the Nike model. You're going to select the whole data tab. You're going to right click, paste special values. And what that's going to do is that's going to overwrite the company's data with the new company that's in there. So now Walmart's data is in the model, as opposed to Nike's data is the model historically. So that's the first thing we need to do. So we need to update the Walmart data. Okay. Now, once we do that, we have to come to the ratios and assumptions. And we have to also make sure that these are updated with Walmart's information. So one of the first things we'll notice is that Walmart has already announced fiscal 2020 because their fiscal year ends January 31st, not December 31st. So Walmart is in 2021 as far as Walmart's concerned. So 2020 has already happened in the Walmart world because they want to capture the whole Christmas selling season in their sales. So in assumptions, I got to change this from 2019 to 2020. Now this is actually going to update the entire model. So all the relative references for years will adjust based on changing this assumption. Next, cash is a percentage of revenue. Walmart, and you can actually see on their balance sheet, has negative, unhide their balance sheet, actually have negative excess cash. And the reason why they have negative excess cash historically is Walmart doesn't keep a lot of cash on hand. So what that practically means is, I know we had put in 2% as operating cash. Walmart actually lives on 1%. They don't actually use 2% operating cash. They use 1% operating cash. So they have less operating cash. That's probably not something you're going to change for other companies, but that was true for Walmart. You can't have a negative excess cash balance. I'll go back to the balance sheet. That makes the historical excess cash positive. Next assumption we have to look at is their WACC. What is Walmart's WACC today? Well, I'll give you a screenshot in that folder. The Walmart WACC today was 4.7%. A lot different than Nike. So again, I'll go to my valuation, change this to 4.7%. Right? I'll put 3% as a G for Walmart because they're probably closer to the US economy growth. But the next part, we'll change that later. Shares outstanding for Walmart, probably going to be different. Off of the description in Bloomberg, the current shares outstanding as of today, 2,832.3 million. So 2832.3. 2832.3. And Walmart's stock price earlier today was at 115.17. So this is going to just be important because somebody mentioned this last week. When you do your group project or an assignment, you may do it at a different time. So therefore, you need to have the price as of the time of your valuation. So this morning, 115.17. Then the analysts have forecasts for revenue and EBITDA. Well, what was that this morning? That's going to be on a screenshot called EEO. This is the consensus estimates.
We lost.
Oh, sorry to come back yet.
Yeah, you're back.
Yeah,
Okay.
you're right.
So we see the consensus estimates for the next 3 years, which is what we're going to use for revenue and EBITDA, and we want to put them in. So for 2021, 539,786 million. So 539,786. Then it's 554,882 in sales. 554,882. And for 2023, it would be 572,190. All right, for EBITDA, 33,488 in 2021. 34,402. And 35,604. So the market's assuming about a 6% EBITDA margin, continuing going forward. EV to sales today for Walmart, 2022 second forward year. That's what we're using. EV to revenue is 0.71. So they generate 71 cents of value for every dollar of sales. And EV to EBIT is 17.15 today. This is 2 weeks from now. Basically 17.15, which says their long-term margin's got to be 4%. So now we go to the ratios. This needs to be 4% in perpetuity. Obviously, it's not because we have Nike's numbers in here. The biggest danger of reusing the model is that whatever company you were last working on, their data is still in there. So one of the things I like to do on the ratios, just to clean myself up, is for these out years, equal the previous year and just carry that through. So that way, when I start, I don't have any weird hard-coded numbers from Nike lying around in my Walmart valuation, because that's going to really screw up the share price. Same thing with even the tax rate. I'm going to put them back to just running them out. So here's what I know. This number needs to be 4.1% in perpetuity, and right now it is. So essentially, this is a reasonable EBITDA for margin going forward, and these were the next 3 years that were forecasted. These growth rates are the growth rates from the EEO. So the question is this a reasonable tax rate? And is this a reasonable level of productivity? Well, 0.28, you tell me. Is spending 28 cents per dollar a reasonable level of productivity for Walmart on capital? Does that look reasonable? Should we change the balance sheet?
I mean, based on what they did historically, it looks pretty reasonable. I mean, it's at the top part of the range, but it doesn't seem out of the ballpark.
So that seems even conservative, but here's the point. I mean, unless they fundamentally change the nature of their business, for the last 6 years, this has been their productivity. I'm not saying it will always be that way if they go to more e-commerce, but you can make an argument it's a little less if they go to more e-commerce, but don't know. But regardless, probably it's not going to affect the share price too much. All right, we still got to get the share price to 115, and we're at 15. So obviously, some things have to change in our model to do that. So what is a reasonable growth rate? And what's causing the model share price to be 15? Well, back to assumptions.
Why is your WAC 10.1? I thought the WAC was 4.7 when we looked at it.
Yeah, I changed the wrong one.
Oh, okay.
So what this was supposed to be, I changed the wrong one. This is supposed to be 4.7. Thank you. And this was supposed to be the EPEOY M13. ROIC is 16. M16. Boom. All right, this is going to give us a much more reasonable share price. Actually, it's $235 a share, but at least it's not so crazy low. So what this suggests is the growth rate's probably smaller. By the way, if we did 1% growth, Walmart is a $550 billion company, and we changed our CVG to 1% long term, notice the share price gets really close. So if they're growing 2 to 3% and then they're closer to 1% long term, and by the way, we know we need to change sales because everything else seems pretty reasonable, and that's the last thing left to change. So 1%, matter of fact, I'll go here. What if it were 0.5%? I'm within 3 cents of the share price. As is valuation Walmart. Save. I know I went through that relatively quickly, but again, I'm going to pause. Questions?
Yeah, I have a question.
Please.
I have two questions. So one is when you changed around the ratios, like the revenue growth rate from 3% to 1% or 0.5%. So what is the justification for that? As in, do we do it just so that the share price has to be within the 10 cents or 50 cents?
So hold on. As I answer your question, I'm going to put this file that we just did here in case anybody wants to download it and look at it more closely than what I have on the screen. So when you were asking about justification for changing, which ones were you talking about?
For the revenue growth rate, like, so it was, so initially when we just plugged in the numbers from the screenshots you had from the Bloomberg, the share price was really off the mark. It was double.
So the shorter answer to your question is I want to take it more holistically. So there's 6 things that we're basically changing in this model. We're changing the G, we're changing the WAC, and by the way, why does this say 10.7, 10.1? I thought the WAC was 4.7. Did I do the right?
I
This
think
is
yeah,
Nike.
by your Nike,
Yes.
yeah.
You opened Nike's.
I opened the wrong one. I was like, that's not their WAC. We're just doing this as is. Here we go. Say this again. So the WAC, 4.7, the G, the hat, 0.5. And then over here on the ratios, it's really and they're highlighted in gray. These are the 3 most important things: growth, margin, tax rate, and again, some degree of the balance sheet. But what you're going to start to see is for the vast majority of publicly traded companies, you probably don't have to muck around with the balance sheet because unless they do something dramatic to their company, the productivity is going to probably stay somewhat similar over time. Unless you have like this terribly inefficient company that becomes efficient, or you have somebody that like sells a bunch of assets, it completely changes their business model. If they're running it similar way, generally you could probably leave this alone. So what that leaves is tax rate, margin, growth, G, WAC, okay? So what we're doing is process of elimination. Coming up with an assumption for a tax rate, that's actually relatively easy to do, right? Because we can actually get guidance from the company, and more importantly, we can look at the market and see what their peers are doing. So I don't think the tax rate's too far from what most people think. Same thing. We know what the EBITDA margin is for the next 3 years. That's what Wall Street's consensus estimates tell us. We know the next 3 years of growth rate. So these I'm pretty comfortable with. We know based on the trading multiples and the academic formulas, this has to be the perpetuity margin assumption. So I'm pretty certain that when I go into perpetuity, that this margin is probably close to what it needs to be. So through process of elimination to get the share prices to match, all I'm left with is 3 years worth of growth in G. So what we're kind of doing is we're saying, okay, since the other variables are more known, we're backing into kind of what growth supports the price. Now, technically, I could have done some more EIC analysis and I could have said, all right, maybe this growth rate is a little higher. So for example, if I went to Bloomberg and I went to Walmart and I just looked at what the analyst said, one of the things about the analysts is they actually forecast growth rate for more than 3 years. And I could have seen that, hey, in year 4 and 5, they're at like 1.76%. And see if there's any analysts that are beyond this. And then 1.93%. So I could have put in 2% for those 2 years instead of 1%, and then basically lowered my G a little bit. But the point is, I'm kind of backing into the growth in the G. Now, in next week's videos and in next week's class, I talk more about how we estimate G, okay? And I'm doing it kind of back of the envelope today, and there's actually another way to get G from the multiples. But I'm not giving you all that this week. I think this is enough. But essentially, the long answer to your short question is we kind of back into the growth because the other numbers we have a general idea on. So it's kind of like need 5, have a pretty good idea of the 4, solve for the 5th. And the key here is I may disagree with this. Remember, this is an as is. I'm not trying to put my opinion in here about what I think Walmart should be. What I'm trying to do is back solve a mathematical equation because I know what the academic formulas are and I know an answer. So I'm trying to figure out using the formulas and an answer, what numbers lead to that answer. That's the whole point of the as is. So I have a general feeling of what the market says. Approximately similar margins, approximately similar productivity and tax rate, basically lower growth is the only way that explains the current share price at this whack. Other questions, comments, questions, thoughts?
Yeah, I'm sorry. I have one more question.
Please.
This is regarding I think the operating cash as percentage of sales. I think it is in the next tab, right?
Yeah, it's right here.
Yeah. So could you just explain why you changed that to 1% once again, please?
Well, if you read through the book, they say there's 3 ways to estimate operating cash, right? And one way is we just say percentage of sales. So one of the placeholders is, as a rule of thumb, you say, look, 2% of sales is 1 week of cash. So there's very few companies out there that can operate with less than 1 week of cash. All right, you start running into severe financial problems when you have less than 7 days of cash on hand, right? So the idea is most companies aren't going to big companies aren't going to have less than a week of cash. So 2% operating cash is a minimum. Now you could have more. Now what McKinsey says is the second method is you could say, okay, you could go out there and you could do some regression, figure out what cash balances are, try and figure out where you think companies are maintaining minimum cash balances. That gets more problematic. What I actually do in the real world is I have access to CFOs and treasurers. I just ask, say, how much cash do you need on hand to run this business? No, they know. They have a good sense of that for the business. Now, here's the thing. For Walmart, I would say for our purposes, just use 2%. I think that's a reasonable assumption, which is 1 week of cash. But what I noticed when we had 2%, by the way, you'll see the change in share price. It doesn't matter too much the share price. But the point here is that when their balance sheet, you looked historically at 2% of sales, they had negative excess cash because the two together represent their cash balance. So Walmart has consistently run extraordinarily tight on cash, right? And I think what they do is they're all about cash flow management in the supply chain, but they're also such a big company, they're not worried about using working capital loans, lines of credit, commercial paper to fund their business. They know they can get it whenever they need it. They know they can get it cheap. So they're just not worried about cash. So what I said is, okay, since I saw these numbers negative, I just did this before class when I was pulling their data. I thought that to make it more reasonable, 1%. Now you could have left the valuation alone. It wouldn't really change too much at 2, but that was the rationale for changing it.
Okay, so the operating cash on this tab doesn't mean the operating cash on the income statement.
No.
Okay. So that was my confusion. Okay, thank you.
again, please ask these questions. I want to make sure everybody's very clear because you're going to be using this model not only for your assignments next week, but also for your group projects. Because I'm going to start putting the data, as I just did for Walmart, for each of your companies in your team tabs coming up.
Hey, Professor, I had a quick question about for the final project.
Yep.
So my group is the Peloton group. So I guess we're only going to get 3 years of the data. So I'm assuming that's going to cause some issues with this model. We'll probably have to alter it a little bit.
It shouldn't. I mean, one of the things I would request that you do is soon, like in the next week or so, take what we just did for Walmart, put it into this model with the Peloton data once I put it up there, make sure that it's not like crashing the model. But I don't think so, because what matters more to the model, the Peloton as an example, is do they have this? Because you're going to need future cash flows to do the valuation, right? But I will tell you, you're going to have a problem. Let me use a different word, challenge as a group. Because in order to get a positive share price for the next 3 years, they have negative cash flow. So when you put in the next 3 years of growth and margin, it's going to basically, think back to the assignment you did in week 1, where you're going to have growth at a negative spread, and you're going to get a terrible share price in our model. So what you're going to have to come up with is a year 6 cash flow and a year 6 margin and a year 6 growth rate that doesn't currently exist. Because that's what Wall Street has to value them on. They have to say, all right, the next few years, we don't care what they do. When they get to scale, here's what we think they are. And so that's going to be the one challenge with Peloton is they're not at scale. And the margins that you're going to actually have to calculate are going to be far different than what they're actually doing in the next couple of years to justify the share price. It'll be an interesting exercise.
So I see there's no EV over EBIT down the
They don't
bottom.
have a profit.
Yeah.
That's the problem is they don't actually have a profit. So they don't have a PE. They don't have an EV to EBIT, and they don't have an EV to EBITDA. So what you're going to have to do is you're going to have to create your own synthetic one in the model by basically creating a positive margin, because you see in the next 4 years, they don't make money.
Yeah.
Which means if you don't make money, you can't be worth $28 a share. Eventually, think perpetuity, all of the value of Peloton is in perpetuity. So you're going to have to create that to do the valuation. It will actually make Peloton more challenging than, say, it's somebody who's doing Walmart or waste management.
Got it.
Not too late to change. All right. Other questions? These are good questions. Other questions? Okay. So again, to summarize, what we did in class today is 2 things. 1, we took Nike and we updated it to current information. And it was not in the assignment, but I just wanted to kind of do it as of today to show you a little bit of how to update the model. And we did an as is for Nike today. And then we created 3 scenarios, a bull, a bear, and a target, which means that when you do evaluation for this class, you're going to do 4 Excel models. You're going to start with your as is. You're going to then do your bull, your bear, and then you're going to create your target. And when you submit next week's assignment, you're going to submit all 4 Excel models. Okay, so create the as is, save. Create the bull, save. Create the bear, save. Create the target, save. Upload all 4. When I say write up your assumptions, I said there's 5 or 6 key assumptions: growth, margin, tax rate, WACC, productivity, G. What are you changing as you go through all the 4 of those models? And just conceptually, why are you changing that? That's the write-up, okay? Because you can plug and chug and solve things, but I want to know why you're plugging and why you're chugging, okay? So that's the context that we started to talk about earlier in this call. Then the second thing we did is we said, okay, how would we do a brand new company? So we did Walmart, right? We took their data, we put it in the model data tab. We updated everything. We did an as is for Walmart. I didn't do the bull and the bear, but basically showed you how to update the model. So again, you're going to have to do that for your next week assignment, and you're going to have to do that for your group projects. That's what you're about to be practicing, right? So again, you can't do this, unfortunately, on your own. All right, so for next week's assignment, I will post the next day the data and the screenshots so that you can actually finish your next week's assignment. And then to the teams folder, I will fold for each of your team group projects, I'll post the data for each of those companies. So if you want to simultaneously practice it on your companies, you can start that process. But that's what we're going to do for next week. And this is what we're calling the valuation, which is covering 2 weeks just because it's a little bit more complex. But this is kind of the quantitative part of the class. Again, questions about any of this? Makes sense? All right. So sorry for the logistical problems with Zoom. They actually did a university Zoom that they said would work. It clearly didn't. I have to figure out why it didn't. But nonetheless, this recording will be up on YouTube shortly. And again, look forward to seeing everybody in 1 week. Stay safe. We're done for the night. Have a good evening.
Thank you.
Thank you.
Bye-bye.